started with our last session, investment, where the money is going. So I am privileged to introduce the moderator who will introduce the speakers. Now, the last time I think I was hanging out with Joanne, we were doing a radio interview together at WBBM News Radio. We were talking about innovation in Chicago. She was talking about her company that she was the founder of called Mycocycle. This is a garbage-eating mushroom company. It's probably a nice, succinct way to explain it. She is quite the innovator in her own right, and she's going to lead this great conversation focused on money. Where is the money going? Where are investments going? What does the future look like? How do we get there? And what are some hot trending things? Now, today, Joanne actually has joined a new organization called SecondMuse, and she is the Senior Director of Business Development in their climate vertical, where she leads strategic partnerships and growth initiatives that advance climate innovation. She's been at this for a very, very long time. It is part of her DNA is to be a climate advocate and spokesperson. So we're thrilled to have her as the moderator of our last panel. So please welcome Joanne Rodriguez.
I thought we should title this Show Me the Money, but having been on the other side. So Bala, David, Alex, come on up, no particular order. I know that we're the last panel before the festivities, so we're going to try to keep this light and informative, even though we're talking about the money and I expect them to cough some up. So for context, we've spent the day looking at the problem and the blueprints. This panel really is about the funding and the financing and who's writing the checks, at what stage, and where they're still getting stuck. And I think it's important, having been on the other side and raised close to $12 million in dilutive and non-dilutive capital, it's really hard out there for a pimp. You know what I mean? Like, you just... And it's ever evolving. It's not the same on any given day. And I mean, even for the organizations and Naomi talking about trying to raise money for something that's amorphous, like, I get it. So we're going to hear from the experts on what we're seeing now, recognize the difficulties in the funding cycles, and how we get over some of these hurdles. So I'm going to go down the line here. I would like you to introduce your organization. Now you have to remember all of this. Where do you sit in the pipeline? Are you an early bet? Are you a growth check or builder? And what has to be true about a deal before you'll do it? So innovators, listen up.
Thank you. My name is Bala Nagarajan. I work for S2G Investments. We're a Chicago headquartered venture growth equity investment firm. We invest across 3 verticals: food, ag, energy, and oceans. And we offer 2 solutions. One, a traditional equity check solution. The other is a structured equity or a credit solution, which is to finance deployment of projects and hardware. So I sit on the growth equity side, so I'll talk about our product, which is we invest anywhere from $25 to $75 million, so not venture, not traditional private equity. I would define companies that are a good fit for us as ones that are not growing fast enough for venture and not ready enough for private equity and buyout. What needs to be true for a company to be of interest to us? They need to have, so we take execution risk. What I mean by that is we don't take technology risk, we don't take product market fit risk. So you need to have successful, happy customers, you need to be scaling organically, then we would be interested.
Awesome. Yeah, I'm David Emsheimer, co-founder of Clean Earth Renewables. We're an early-stage climate tech startup focused on scaling community solar and grid-scale energy storage. So we sit in the 2 to 10 megawatt project size. And interestingly enough, we all seem to have really close partners that we know. And these guys, some of these guys could very well be the ones giving us the checks for projects that we invest in. So that's a little bit about us.
I'm Alex Behar. I'm a partner with Buoyant Ventures. We're an early-stage VC fund. We invest in what we call the intelligence layer for the physical world. So what that means in practice is mostly AI and software solutions, maybe some simple hardware to capture data like a sensor into industries like energy, industrials, computing, and climate resilience. All of our investments drive some kind of climate benefit, so be that decarbonization, resource efficiency, or resilience. Where we sit in the capital stack is early, but not the earliest. So we are a seed and Series A investor. What that means in normal language is that we're investing in companies that have some kind of market evidence that their solution has value. So that means early paid pilots or early recurring revenue, that kind of thing. We're not investing at the earliest stage, which is, just an idea. We look for many things, as you might imagine. We're, screening a few hundred investments to make one. So the stars really have to align. But at the high level, we're interested in founders who have a reason to do what they're doing. So they have some kind of founder market fit and the grit to embark on this journey. And then we're looking for an obvious competitive moat, and we're looking for that kind of early traction with high credibility customers that I refer to.
And I'll point out that the fund sizes between S2G
Right.
and Buoyant are vastly different, but their conviction on what they're funding is no less the same. So yeah, I'm always quick to point out that just like entrepreneurs and innovations and founders, all funds are not equal. They're different in what they look for. So understanding the approach is critical. And so, Bala, I'm going to talk to you a little bit about the missing middle. Some of us would call that the valley of death, the technology chasm. But there's a real gap where a company's too big for a grant, but not proven enough for infrastructure money. And so that is the missing middle in a funding perspective. I pulled a Deloitte report because they're like everywhere, and I could pull 100 other reports, but it just happened to be Deloitte's. They estimated that about $135 to $200 billion in opportunity exists to help scale commercially viable solutions through the missing middle stage. And there's a fund, Climate Investment, you all might be familiar with. They specialize in venture capital for decarbonizing heavy emitting sectors like energy and industry. And they just raised a $450 million fund with this specific purpose in mind, bridging the gap with proven pilots. So, Bala, where does it bite hardest for you? And what's actually worked to close it? And what friction still exists? There's good and bad, right?
Yeah, I didn't come here to plug S2G, but you should all read this paper that we put out on the missing middle as well. I'm surprised you quoted Deloitte and not S2G. No offense taken.
And I'll buy you a drink.
Thank you. So I think the missing middle, there are many definitions of missing middle. The one that the lens with which we look at it is companies that, as I mentioned before, are not growing fast enough for venture capital. Why do you need to grow fast for venture capital? Because, and Alex will explain this better than I can, venture capitalists look for something called a power law, which is they invest in 10 companies. You need one of those companies to be wildly successful, the rest of which will make up for the fact that the rest of the 9 may or may not be successful. So, which means that for you to be wildly successful, you need to be growing, because growth is what attracts sort of those exits. But not all companies are meant to, supposed to, should be growing at those 300, 400% CAGR. So what happens is if you're not growing at that clip, then the venture capitalists traditionally tend to not be interested in those investments. And just as we all grow up, there are growth spurts. I have a 3-year-old at home. I'm hoping one fine day she's going to be as tall as me. But as you all know better, it's not going to happen linearly. So with many of the climate companies in particular, we're still working within the bounds of physical infrastructure, whether you're putting energy assets to work or you're creating wastewater treatment plants. This is not like AI software which can go up and to the right overnight. So we've seen a lot of evidence and data to prove that there are many backable good companies, but companies that are not growing at that clip, but don't have what we call as consistent EBITDA, which is earnings, because you're still growing. You have to invest in that growth, which means that a traditional private equity fund would not be interested in investing in you. So the value of death or the gap is you proving to the investor that I can still grow, because if you're not growing, what's the point of investing? This is a lifestyle business, so it'd be very difficult for you to attract any investor. So the way to get out of the valley of death is to find that investor who's willing to bet, even though you're not growing at 100%, but you're growing at 20, 30% at a more reasonable valuation for a more reasonable outcome. And this is very important because as you think about who is the right capital partner for you, as Joanne said, you should also think about what is their expectation. If you're taking money from a venture capitalist and they expect you to make their entire fund through that one investment, they have outsized expectations of you. On our side, we're looking to make call it a 3x return on our investment. So if we put $10 million in your company, we're looking to make a $30 million return over a 5-7 year period. But what we also don't want is a zero. So I cannot afford a capital loss, right? So that I'm not a venture capitalist. So I'm looking for a risk reward between at least making my 1x to making a 3x. Whereas a venture capitalist would be looking for, I'm happy with a zero, but I want you to hit a 50x on my deal.
So if I can make up for my faux pas, I do have a note here that S2G's own Frank O'Sullivan has publicly argued the industry needs to stop pitching hard tech infrastructure like software. Do I get points back?
Agree. Yep. Sure.
Okay. Awesome. So I want to make a comment on the missing middle, having been there, right? And you just are in this eddy. And when you have manufacturing, you have to build, you have to de-risk a lot of things and hire a bunch of people. But the missing middle isn't just a financing gap. It's an ecosystem gap. From where I sit with SecondMuse, a lot of these solutions already exist. They're technically ready, but nobody's done the work of building the pipeline and building the proof points that make a later stage investor comfortable. And so that's where we sit, not as a fund, but as the connective tissue through non-equity investments, non-equity structures and public-private design, so we don't force a raise too early. The sticky point we see is timing. Like in grant funding and public-private partnerships where we operate, that could be 12 to 18 months, but a company may not have that much runway in bandwidth to withstand it. So we're going to do an audience poll. I love these. So I'll read it while he's teeing it up, but you could think about it. Which climate technology do you think deserves the most investment? A is advanced energy and grid infrastructure. B is food and ag. C is carbon management and circular economy. D is AI and digital climate solutions. What do you guys think up here?
It's not looking good for me. We invest in the fourth column here.
It is looking good for you,
Just
right?
reversed on you.
What I will say is that these are not mutually exclusive. You can be investing in AI and digital solutions across the other three.
Right, exactly, yeah. The categories are a bit blended. But look, it's like a 3-horse race. So we have a very informed and diverse audience, which I appreciate, which means that, we'll see a lot of supportive solutions coming out of those sectors. So this next section is really kind of geared towards David and Alex. And this is about deployment bottlenecks. U.S. community solar just crossed 10.1 gigawatts of installed capacity, but 2025 installations actually fell by 25%. We see that will rebound through Illinois and mid-Atlantic markets in 2026, but there really is a need for capacity to build the infrastructure, and community solar is evident, right? There's a need for it. So through permits, interconnection, storage, the physical build-out is slow no matter how much capital shows up. David, where are you actually stuck on the ground with this as a community solar provider?
So where we're stuck is I guess what we're really doing well right now is we're aggregating the right land that's zoned properly or the right rooftops in the right interconnection zones. And so what happened, what you saw last year was a lot of uncertainty due to the shift in the ITC. That's now ramping back up, especially because Illinois just passed the Clean Reliable Grid Act. So that, the 10 years that it took to get the 10 gigawatts, we're now going to need to add 3 gigawatts in the next 3 years with storage alone. And we're really pushing around 2 gigawatts a year in Illinois with community solar, the way development timelines and cycles and NTP dates are hitting now. So, I think what we're doing, like I said, what we're doing really well is identifying the right zone properties and the right interconnection zones to speed that timeline up.
So Alex, Buoyant's investment strategy targets software and AI specifically because digital tools can act as an intelligence layer, squeezing more efficiency out of our existing infrastructure and fast-tracking development timelines. Where can software actually buy back time instead of just efficiency?
Yeah, so that's the crux of our thesis, right? That climate action is required today. There are a lot of attractive, viable solutions kind of in the more deep tech space that just need more time. And in the meantime, we need digital solutions to accelerate and improve what we already have. So solar is a great climate solution that is ubiquitous and exists today and can be deployed and make a difference and makes economic sense today, right now. So how do we use AI and software to accelerate that and maximize that benefit? That's the thesis that we come at this with, and that not only applies to technologies like solar, but many others as well. It's also the idea of making the most of what we have. So as we think about the first column that was on the poll there around grid infrastructure, there are some very physical constraints to get to expanding the grid, and we need clean power today. Power demand is growing. We're going to meet it one way or another. That's just the reality. And if we can use software solutions like a few that we've invested in that can allow us to make the most of the power capacity and make the most of the grid that we have today, that's a way for us to buy time for other solutions to be market ready.
So I'm curious how smart capital and digital optimization help developers deploy physical climate infrastructure faster, so bypassing the usual institutional delays, primarily for David and Alex, but Bala, you're also welcome to chime in.
Yeah, I'll start. I think smart capital is looking to deploy right where they can see the de-risking of the zoning and of the interconnection. And so if you can find those opportunities with the right early stage developers that's what they focus on exclusively, or they do that really well at scale, that's where the smart capital is going. And that's where I'll stop, and I'll let you jump in.
Yeah, I'll make a point. I guess it applies to community solar specifically, but also just new energy projects in general. There's kind of there's a lot of speculation in terms of calling out a specific example of, you're an IPP, an independent power producer, you want to build a new project, you have to get in line to get grid connected, and there's a lot of hoops to jump through, and there's a lot of nuance, and there's a lot of market understanding required to do that right. And there's also a lot of speculation, right? Just get in line and see what happens. So the extent to which software tools can help those developers identify which are the right sites, what is actually going to get connected faster, how do we do this in a way that understands the realities of the land you're going to build on, the communities you're going to build within, et cetera, that can help us build projects faster and in a way that everybody benefits.
I've seen the biggest benefit of software and digital solutions on existing assets and existing infrastructure, in particular around the grid. We all know, given increase in demand for electricity, even before data centers came into our world, there is an increasing demand for electricity, which requires us to build more infrastructure. But you may or may not be surprised that the current grid infrastructure is used at less than 50% of its peak capacity. So there is plenty of capacity available in our existing grid, and this is where software, digital solutions, sensors can help optimize the existing grid rather than us putting more money to work. We've seen significant adoption of that space.
That's great. And so I think we have to go to the areas of underinvestment. And I know this will be a little bit of a hotbed, but everyone's chasing AI, batteries, carbon removal. What climate solutions are not getting funded that should be? So going to Deloitte's report again from January 2026, they flagged adaptation, which, I'm an A&R girl, adaptation resilience, but adaptation finance was chronically underfunded relative to mitigation. Mitigation has clean revenue models, right? You sell solar, it's pretty cut and dry. Adaptation value shows up as cost avoidance, which is much harder to monetize and attract capital towards. So I'm curious what you guys think is underfunded in this market.
Oh, sorry. Yeah, I'll quickly shout out Naomi Davis. We were on a panel last year together, Blacks and Green. She touched on a point of community investing. And so, I think what is heavily underinvested and underappreciated is the fact that you can do heavy community outreach and heavy community action campaigns. And so that's something that we leverage and we deploy exclusively before our projects are at the permitting or at the zoning hearing stage. This is for energy storage. This is where you're talking about stationary batteries that if they're in a specific part of the community, they can look a little funky and not aesthetically pleasing, but they serve a really dire purpose on an energy grid. And so when you get an outreach campaign going early on and you show the tangible benefits like peak demand shaving and savings on power bills that the local customers can see that it's going to hit their power bills and help their power bills drop, and the potential savings of subscribing to a community solar project. When you deploy those community outreach and partner with the right community agencies early on and incentivize them, that's a really strong benefit to the community, and it's a tactic and a strategy that more folks need to be deploying. Specifically, what we did in Skokie last year, there was a round of community solar projects being built on some rooftops out in the industrial park out there by a big major Skokie substation. And so we partnered with an action agency. We got over 50 people enrolled in a matter of weeks. And able to help, what we did was we helped fund the community action agency itself. So we used them to be an approved marketing designee under the Illinois Shines program. So we educated them how to do the enrollments, how to actually communicate to the residents. There's several different languages of being spoken in Skokie, so Arabic, Spanish, Russian, Polish, you name it. We had to get several people trained and marketing material out so they could communicate to the different types of residents and educate them on what the benefits of community solar were for them. And then another piece of the community outreach and education is working with municipalities that have to deploy their sustainability strategy. So we're working with the community out in the west suburbs, and I'm not going to name any names specifically, but they are massively under budget with their energy spend and with the commitments they're trying to make. And there was a new mayor that was just elected, and they put together over the last year's sustainability team. And we put in front of them a proposal, a public-private partnership proposal, where we bring the IPP's dollars to invest in the projects. We identify the sites for grid-scale energy storage, for community solar on rooftops, on brownfield. We're handpicking the right places for them to really show this is what we can do and become a green city. And we got some interesting news via email where we told them, okay, here's the actual numbers. So they can earn $15 million over the next 15 years to do absolutely nothing, but all they have to do is assign the rights for the development for the solar and the batteries. You're talking about roughly 20 acres for a 2-megawatt project. It's on a brownfield, and then you can co-locate, because of the capacity there, you could co-locate 10 megawatts of battery storage. So you're talking about 2-megawatt solar, 10-megawatt battery storage on a brownfield. Now, there's another couple sites where we can get another 30 megawatts of storage and another 2 megawatts of solar. So 4 megawatts solar, 40 megawatts of energy storage. All they have to do is sign the options agreements, review, they have a legal counsel, they have the ability to do this. And they said, you know what, we don't have the resources to deploy this strategy. And I'm saying, as your resources is your time and your effort into doing a legal review and to understanding the entire value that this is bringing. You're talking about $15 million in tax revenue that comes with that, just from lease revenue, because you own the land, you have the ability to lease out the space for the solar and the storage. Where are you missing out on the fact that you don't have the resources? You have the resources, they're right here, we're bringing it to you. So bottom line is, for that municipality is, and for those that are looking for a solution like that, the resources are there if there's someone coming to your community, or if you're able to find someone to bring those solutions to you. And for that specific community, I hope we get to change their mind and keep working with them. But it's a great benefit, and it's just crazy to see that something like that could take place.
I might know that mayor. I think I know what you're talking about. I could help you. Alex?
Yeah, so I'll take a much more macro view, and it's a bit of a cop-out to your question, but I think climate as a whole is still underinvested in, right, as opposed to particular areas within it. And I mean, especially recently, I think the stat was for the first half of 2026, almost half of venture capital funding went to 2 companies. You can probably guess who those are. So they are just hoovering up, OpenAI and Anthropic are hoovering up every single, 1 in 2 venture dollars that exist out there, which means significantly less available for everything else, right? And climate tech funding is increasing. I don't want to give the impression that it's declining, but it could be ramping up much faster. Hopefully with upcoming IPOs and that kind of thing, there is more capital filtered kind of back into the system, and there is more money for climate. But I think that's the macro picture we're dealing with as investors within climate. And then within climate, I will actually answer your question. So I agree fully on the adaptation and resilience that's underinvested in. I think particularly the part within that's underinvested in, we're seeing a lot more call it underwriting or analysis of risk. So now we know insurance companies know that there is wildfire risk in California. Okay, bravo. But what we're seeing that is underinvested in is, okay, well, how do we actually do something about this? How do we actually reduce the risk? So we've gotten to the point where we understand the risk better, and it's taken us a while to get there. But now we need more investment in the real resilience and adaptation to reduce the risk.
Yeah, maybe 2 cents from my side. The reason dollars are not flowing to adaptation is because we don't have a carbon price. Once you have a carbon price, everything gets priced accordingly, and therefore the dollars will come in. We're very far away from that, unfortunately, as much as everybody would want to get there. But in the interim, what do? Insurance is a very good play because that's a tangible benefit to homeowners and communities. I think the other place where we're seeing investments coming into adaptation is from large utilities, because effectively, as customers, ratepayers, they are doing this on our behalf, especially if they're publicly owned. They need to take a 5-10-year view of their assets. Many utilities have large substations, infrastructure in flood zones that they never thought would flood, and now they're getting flooded. So they are putting real dollars behind protecting those assets, and therefore are emerging as the first willing buyers of insurance products and willing to invest in adaptation techniques, products and solutions. So maybe not so once a customer emerges for these products and solutions, the investors are like lemmings, they'll follow soon. So I'm hopeful that we're seeing the customer demand pick up on one side, and therefore the dollars should come on the investment side too.
Yeah, I think reinsurance will have a lot to say around this. And fun fact, a couple of years ago, major investors were encouraging their portfolio companies to work in the words AI and large language models into their decks just so that they would pass screens to be able to be considered for investment, which is really sad if we think about the devastating impact that AI and large language models have to the environment. You know, there's a middle ground there, but that, you know, when the money was scarce, that was the coaching we were all getting at the time. A look behind the curtain on that one. So this is also, for this entire panel, risk mitigation. So this is a good lead-in. What has to happen in the next 5 years so climate deals stop looking risky to mainstream and non-specialist capital? Bala, I'll start with you.
Can I say carbon price again? No.
Yeah, you can. You can say carbon price.
I think because we're underestimating the long-term impact of, I mean, I believe we're underestimating or underpricing the long-term impact of climate change potentially, because of which we're unable to therefore truly price that risk and therefore put dollars to work against that risk. If you knew exactly that your house is going to get burnt down because of a fire or there was a flood, you're going to have a flood, you'd happily pay more insurance to protect against that risk. But nobody's going to tell you it's going to happen in the next 12 months. They're like, you may be in a flood zone. You may have to do this in case a 1 in a 25-year flood arrives. So I think with the advent of technology, this is, technology is like we have more satellites up in the air. We have more sensors being deployed all across. AI, for some of its positive outcomes, is that we're able to better predict and forecast weather. With advent of technology, I'm more confident that we would have data emerge to price that risk better and therefore reduce the cost of capital for backing some of these initiatives, which we've been unable to do so far. So my answer is technology, pricing the risk better, and therefore driving more dollars into the space.
I'll say from the ground level, to get more products deployed, that's really what's going to help drive down the risk of further investing in these projects. So you need more landowners to sign land contracts to get into the power queue, and that is going to help drive larger portfolios. It's going to help bring down the cost of capital for investors. And I think for the long term, if that train can keep going, and we can hit this 3 gigawatt goal for just for energy storage purposes in Illinois, that will really show the rest of the country, all right, we need to do more procurement targets like this. And just like the community solar model has been growing in other states, the same thing can happen in energy storage for the grid scale community.
I'll take the chance to say more about adaptation and resilience. It's a big theme for us. The counter to the carbon price point, right? That's a great market factor. The benefit that adaptation and resilience has is that when you are exposed to a disaster, you feel it today, right? And there was a study by Sarah Kapnick at JP Morgan talking about how when executive teams at companies experience some kind of natural disaster that has a real financial effect, they're more likely to invest in adaptation and resilience measures. And the cynical view is, well, we're going to have more of these events, more people are going to feel the impact, so more people are going to do something about it. There's at least a silver lining there. But I think there is some, call it financial innovation coming into this space that should help. So there are examples of catastrophe bonds which are much smaller than they need to be, but they're growing. Even better are resilience bonds. So those are essentially financial instruments that anybody can invest in and effectively act as an insurer against a natural disaster, but then also help investment in resilience measures. So there's an example of one in North Carolina that invested in improved roof shingles to prevent the impact, the negative impact of hurricanes. So there are examples of kind of private markets starting to wake up to the problem and the opportunity here. It's still much smaller than it needs to be, but it's more than it was a year or two ago.
I'll add that Munich Re today released from the Munich Re Foundation about their resilience fund. And Bloomberg released yesterday or the day before more philanthropy funding around resilience. So it is encouraging to see that. I spoke about 8 years ago at the United Nations on nature-based solutions and the impact to resiliency. It does have a trillion-plus dollar impact to GDP globally. So there is a number. It's just not always a consensus number that we agree on. So
Right.
we have another poll, the last poll. I want to make sure you're all awake. Are you awake? All right. Looking ahead 10 years, what statement best reflects your outlook on climate innovation? A is, and this is a lot of words, but I'll read them, will exceed expectations because innovation will accelerate. B, will make meaningful progress but slower than we'd like. C, progress will depend largely on policy and regulation. Or D, the biggest breakthroughs haven't been imagined yet.
I'm glad there is no E. I give up on this. Not going to happen.
Right? No. Listen, I started a trash-eating mushroom company. We're gonna do anything we can to solve it, right? So let's see, what are we doing
So
here?
half the audience thinks we can't do anything about this.
You guys can do everything about it. Yeah. You guys have the money. Remember, the title of this is "Show Me
Affect
the
policy and
Money."
regulation.
All right, so right now it's progress will depend largely on policy and regulation, and I do agree. I think that that's what gets us tied up, and I'm sure your LPs and GPs are like, well, it's out there, but we could still operate, doing the risk analysis. Can we still do business? If the answer is yes, you really don't pay attention to it just yet. So, all right, we're gonna close this with a round robin a little bit. So stepping outside your own mandate for a second, what's one thing on the horizon that you think brings people together regardless of politics?
The World Cup.
Yes, yeah.
Argentina, if nobody saw the result.
Okay, World Cup.
No, I think. Well, we're in Chicago, and the World Cup didn't happen here this year, but I generally think that it brings tremendous investment in the communities where you build the stadiums and where, for hospitality, we have a lot of hospitality energy customers that we're looking truly forward to the uptick in, foot traffic here, restaurant tours. But generally, I think sports and entertainment is a big, big thing. And in the future, AI is going to actually help the sports and entertainment, and energy infrastructure is the part that's powering all that. So I think that's really cool for the future.
Bala, do you have one thing outside of your lens? It could be World Cup still.
No, I think it's more
Baseball?
to do with, not yet. I think I'll go with mental health and well-being. I think companies are under-investing. I mean, if you think about it, I used to work for a very large corporation, and I found out many years later why they had a gym in the office. Because the insurance cost for the company goes down just by the fact that they have irrespective, even if none of their employees use the gym, the fact that you have a gym means that your insurance costs go down, which was like, I was mind blown by the fact that incentives drives outcomes. So I think if you think about it from a longer term horizon perspective, the more governments, institutions invest in mental health and well-being, will be a happier and a more prosperous society.
Is it Argentina?
Yeah, I'm still celebrating. I've got a bit of a gloomier one, but I think it is still good. What we've seen from the current kind of energy crisis, right, that's happening due to global conflicts is we need more clean energy, right? And that doesn't matter where you sit on the political spectrum. We need more energy. The reality is that clean energy solutions are some of the most viable, quickest, cheapest. So the fact that we just need energy is a way to bring us all together. We need energy to be affordable. Nobody disagrees about that. So I think there is a silver lining there that brings us together.
All excellent answers, and mine is innovation and community. So these types of gatherings really give me a lot of hope. Seeing everybody here, you could have left, but you are the real rock stars and stayed. And so I want to thank Alex, David, and Bala for the engaging conversation, and thank you guys.